Greetings, this is Chapter 9, Video 1. Let's launch. Okay, so today's class we're going to do for the learning objective, identify common business income and deductions. But before we get into that, I want to talk a little bit about the potential use of cash basis versus accrual basis. So if you have a business and the gross income, the gross receipts is less than $26 million for the preceding 3 years, and that's an average, by the way, you're actually allowed to use the cash basis and all of that stuff. So and there's a few things that they say. So business without 3 years of data, use the period for which gross receipts are available. So for example, in your first year of operation, if you have gross receipts of say, $24 million in your first year. I mean, I wish my business had $24 million the first year. But that would be what you use. But then if you have, 2 years of income, you're going to average the last 2 years. And then if you have 3 years of income, you're going to use the last 3 years. And so that's kind of how that works out. Gross receipts for short years must be annualized by multiplying by 12 divided by the number of months in the short period. So for example, if you just start your business in June, you want to do it as a calendar year. So for the first 12, say for example, for the first 6 months, you had, $13 million because it's 6 months, you're going to double that. That gets you up to $26 million right there. And so you got to be able to figure that out as part of this. Tax shelters never qualify under the gross receipts test. And so that's if you're a tax shelter, probably won't be dealing with too many of those. And if you do, it's probably more for an advanced course. So Blue Corporation began operations on July 1 of last year, and gross receipts was $12.5 million. Can they use the cash method, yes or no? And the answer, I thought I was going to have it on the next slide. The answer is yes, they can, because you take 12.5 for 6 months, multiply it by 2, it's 25 million. They're going to be able to do the cash basis for that. So deductions, getting to business income and deductions must be directly connected to the activity. So it's interesting when you fill out a business tax return, they're going to ask you, what's your trade or business? What's your business code? So if I put down that I'm a CPA and I put down that business code and I have things say, for example, I spend money growing trees. The IRS is probably going to question that. Why is a CPA firm growing trees? Now, if I'm doing it because I said, hey, CPA firms burn paper left, right, up, and down, so I went out and I actually planted some trees, they're probably going to see that as kind of it's not really a business deduction, but maybe it could be a charitable deduction, especially if you planted the trees in a national forest or something of that nature as part of a forest reforestation plan. That could be seen that way, but it's not going to be seen as a directly tied business activity expense. Business expenditures must be ordinary necessary. Now, why those two terms? Ordinary necessary. They're very important. Code section 162 talks about ordinary necessary expenses. There's going to be certain things that if you take a look at a Schedule C, there's going to be certain types of expenses that they have on there. For example, supplies, office expense, a car and automobile. There's certain things that every business has to deal with. And then there's certain expenses that only apply to certain businesses. For example, in accounting firms, we go through paper left, right, up, and down. If I work in a car repair shop, probably not burning as much paper as I do here in the accounting field. So there's certain things that are going to be ordinary and necessary in order to accomplish. Now, does that mean that car mechanic shops don't use any paper at all? Of course not. They write up bills on things, they write stuff down, blah, blah, blah. But their paper consumption is probably far less than mine is. Conversely, I don't use any oil. If I'm buying a whole bunch of oil, they're probably going to start saying, wait a minute, you're a CPA firm. Why are you buying oil? That's not an ordinary and necessary expense in order to generate profit. Now, they're also going to say reasonable in amounts means not extravagant. So, and generally we don't have too much of a problem with this. Normally business owners are pretty stingy. They don't want to spend any more money than they have to because they want to increase their profit as much. Like for example, if I go down and I buy, I get like regular copy paper, usually I go get it at Costco It's dirt cheap. I always get it on sale. When it's on sale, I buy a whole bunch of it all at once so I don't have to buy, throughout the time when it's more expensive. But, if I go down and I buy paper that's, say, for example, 5 times the market average, and 5 times is not a level, it's just something I made up. But if I buy something that's 5 times the market average, the IRS may come back and say, whoa, what's really going on here? This doesn't make a whole lot of sense. And then they're going to start questioning things. Okay, so for an example, during the busy part of the year, Rick could not keep up with all the work. Therefore, he hired 4 part-time employees and paid the market rate of $10 an hour to mow and trim lawns. When things finally slowed down, he released the 4-time employees, paid a total of $22,000 in compensation to the 4 employees. Rick still needed some extra help now and then, so he hired Tom, his brother, on a part-time basis, performed the same duties as the prior employees. However, he paid Tom $25 an hour because Tom is a college student who wanted to provide some additional support for his education. At year end, he worked total 100 hours, $2,500 from 100 hours, and received $2,500 from Rick. How much can they deduct? And the answer is you can deduct $23,000, and that's because Rick can deduct the entire $22,000 that he paid the 4 part-time employees. However, he can only deduct $10 an hour for Tom's compensation because the $15 is an unreasonable amount. The remaining $15,000 is a non-personal, non-deductible gift from Tom to Rick. Now, getting under gift tax expense, gift taxes, if he gives less than whatever the statutory limit is, I think it's $16,000 this year, he'll be okay. But if not, he could actually trigger gift tax returns. So that's why you have to be very careful with these reasonableness. And of course, there's going to be a market rate. And look, you don't see too many times where the IRS actually starts questioning these things unless it's pretty blatant. For example, I go to the AICPA's conference, and instead of staying in a normal motel room, I stay in the conference hotel's room at the presidential suite. And my company, my lifestyle is that I live, the average middle class lifestyle. That is way extravagant. Okay. And so they're not going to let you deduct that sort of thing. All right. So that's all I got to say about this. This is, it's the start of the business, tax portion of the class, section 3. We're tracking along. Guys, there's a light at the end of the tunnel, and it is not a railroad train that's coming to hit you in the front. I look forward to seeing you in the next class.